Hello, folks. Welcome to this lesson on bullish breakup block. So first, we'll start off by defining what a bullish breakup block is. A bullish breakup block is a technical analysis pattern that emerges after a failed bearish order block. In essence, it signifies a shift in market sentiment from bearish to bullish. When a price level that previously acted at resistance is decisively broken and retested as support, it creates a high probability entry point for long position. Here is a picture of a bullish breaker block. Let me zoom it up a bit. From this point down here, it can be seen that the market is creating lower highs and lower lows. That is bearish. It might be taking a dip from an overall bullish trend. Bullish means it's making higher and higher lows, but at a certain point, it takes a dip, just like we're seeing here. It's making higher high, higher lows, higher high, higher lows, and then at this point, it takes a dip. Now, from this point, if there's an hourly chart, if we zoom down to lower time frame, you can see the lower lows and lower highs being created here. Now, the identifications establish a clear downtrend. The market should be descending downtrend, descendable downward trend, characterized by a series of lower lows and lower highs. You identify the bearish order block as you look at the last bearish candle or a series of bearish candles. But that this explanation was actually different from different traders' perspective. You identify a bearish order block, look at the last bearish candle or series of bearish candles before a swing low is formed. This area represents concentration of selling pressure. You might want to take notes of this write-up that I have with us trying to pick out the key points of identifying a bullish breaker block. Now, after you identify or locate the last bearish candle, then you witness the market structure shift, which is what you've seen here. This is series of bearish candles. These are a series of bearish candles that confirm there is a swing block has formed, and then next thing we got a momentum rising up. Once it closes decisively above here, that's when you look out for this particular. That's why I said some traders say it differently, but you can, when going to your charts and back test, because whatever I say here would make full sense until you back test it, and then you see how many times this series of bearish candles here, how many times they get retested after the momentum high, after the decisive close above it. This swing has been made. Then next in the market structure shift. Market shifts to bullish. Then one market shifts to bullish and confirm a decisive close above this last swing high here. This last bearish order, these bearish candles here, after the market close above them. Look out for when the market will tap into it. After the market close above it, the market taps into it to confirm that the trend has changed. Now it has turned from bearish to bullish. Once you witness a market structure shift, okay, we confirm that there is a liquidity grab. Some call it stop hunt, some call it liquidity sweep, liquidity grab. Whichever terminology you prefer, you can use. It's just okay. Once you can identify it happening, that's what's most important. Once you confirm the market structure shift, the crucial element is strong impulsive move to the upside. That breaks through the previously identified bearish order block. This break of structure indicates that buying pressure has overwhelmed the sellers. Confirm the liquidity grab before the upward break. This price will dip below a recent swing low, triggering stop loss from retail traders. The liquidity grab or stop hunt provides fuel for the subsequent sharp move higher. Look for a fair value gap, which is what we are seeing here. A fair value gap. Once this impulsive move moves high, look for a fair value gap around this area, meaning that the market trend has changed, market structure has shifted. Look for a fair value gap. The impulsive move that breaks that bearish order block often leaves behind a fair value gap or an imbalance in the market. This is a three candle formation where the wicks of the first and third candles do not overlap, indicating a strong inefficient price move. The presence of an FVG further validates the strength of the bullish momentum. Now we can tell from here that this 1, 2, 3 candle pattern where the low, who's the high of the first candle, doesn't overlap with the low of the third candle. It is perfect fair value gap, bullish fair value gap that we'll find there. Then patience entry. This is where patience comes in. Don't chase the initial breakout. Wait for the price to retrace back to the bullish breaker block. This retest offers more favorable risk to reward ratio. Seek confirmation on the lower time frame for more precise entries. Now, we can tell from these key points. These are the basic things that you require to identify a bullish breaker block. Identify a clear downtrend. Identify the order block. Ignore the market structure shift and confirm liquidity grab. Then look for fair value gap. Now, let's go into the charts. It's understandable here that this market has been swinging low and then before this impulsive move higher. This is on the hourly. Let's investigate this dip here. This dip on XAUSD. Let's go down to the lower time frame. Then go down to the 1 minute time frame. All around here, we can always tell that there are lots of opportunities inside here. Now, these are actually, I think this should be that deep. Okay, this should be that deep, but right here now, we can tell that, let's take this pointer tool and tell that, let me see, zoom this up a bit. We can tell that this market has been making lower lows from here. Though the overall trend on a higher time frame was bullish, it has been bearish, but this dip was now picking. Let's look at it. You see lower low, lower high, lower low, lower high, and then these are a series of bearish candles that went down this way, and then all of a sudden market structure shift, which is high that got broken. This high here got broken. This high got broken. You can tell lower low, lower high, lower high, and then lower low. Then this is the liquidity grab. It took liquidity out of there. This liquidity was generated from the midnight to the Asian session. Then look at what happened here. This price, after making lower low, and then this series of bearish candles where bearish candles formed. Look at what happened. Let me take this out a bit. Look at this candle that formed here before this series of bearish candle formed. Then look at what happened from this high now. Look at what happened here. 1 pixel. You see, market comes back to retest it. Once that impulsive move higher, loses decisively above this last series of candle here. So now take their entries from this point. Well, the whole idea of bullish breaker block is formed. This is the last bearish order block that created this low, which took out liquidity from this point. Look at it. You see, once it takes out this low, took out the liquidity, You see the fair value gap forming here, which just we identified in the picture up there. You see the market coming back to pick up entries from here. The road that the liquidity sweep have been done, then you see the market impulsive move higher, and then market comes in here to take entries and then delivers this high. Now, when it comes to risk to reward ratio, my what I'll target for my exit, for my take profit will be these highs first. Will be this high. That will be dependent on what session I'm trading on. But I'm going to take out my first take profit from here, then taking my money out of the market. If the market returns back to my initial entry, then I wouldn't be worried because I've already taken my profit. Then if I take like 50% of my profits off this high here, then the market returns back to take more liquidity. Depending on what time it happened, look at what happened to the market. Look at what happened. Gold sprang up decisively. It sprang up. Let's look at somewhere else. Maybe we can see more bullish breaker blocks from here. The market took out this liquidity, but it was not very decisive not compared to the initial one. But you can still see, let's look, okay, this is the last bearish this is the last bearish candle that formed. So if you notice, the market still comes back where the market sold over. Oh, no, this is not clear. This is not clear. But the market still roughed up, looking up for this particular one here, because this is the last major fair value gap that formed before this low was taken. The last major fair value gap. Look at the range of this candle. The range of this candle is higher than most of the ranges down here. See, this is the last bearish fair value gap that formed. And then you notice the market coming to this high to take liquidity for continues higher. Before it continues higher, it came here and then boom, the market moves up. So we can always identify bullish breaker blocks on your chart. Once you notice there's a liquidity sweep, we wait for that sweep of the high. Let's look at this. This is a sweep of liquidity here. There was a tiny fair value gap seen here. But you see, while the market fell, I think it didn't go particularly just for the high of this one, but it took a dip. Apart from a high, apart from waiting for the high to be, apart from waiting for the high to be tapped into before markets continuing in a bullish trend, you can also look out for 50% of this range from the point where it took to dip. You can also look out for 50%, but I will leave that to your back testing. By the time you do back testing, we see how many times the market delivered. And of course, when you take an entry here, from this point now to this point, you already know that you have we're 1 to 2, or 1 to 2 at least is already assured. To see what you have here. Okay, this is 1.48. We should take him from those places, but I know this not a very, because this is Asian session. So I wouldn't quickly jump into Asian session because they always hold a very high consolidation level that will be looking to trade when the liquidity is high in the market, when most traders are in the market. Let's look at somewhere else. There's a dip here, but there is not much of a liquidity sweep. And the liquidity sweep with a week is usually high probability. But then the market sprang up from here. There's a market sprang up from here, and then it broke this high only for it. Okay, I think this represents what we're still talking about. This is the last bullish candle that formed, but this is the last bearish that formed. This is the last bearish candle that formed. I think the best bet will be here to take when the market comes on. Then you look in deeper, we can see that the fair value gap was formed when this after this bearish after after this bearish candle was closed decisively above, see a fair value gap forming here. This is where you're going to take your entry. This is where you're going to take your entry to aim for this high. So bullish fair value, bullish breakup blocks are high probability setup, especially when you find them in the discount of what I think I talked about premium and discount PDR reasons, and the premium and discount I made the high day. Let's say that I may without my fibonacci too, from what I can even tell what's the price on a deep discount from here. If the price takes this low, I don't know what happens here. From this 50, from this place, there's the midpoint of this PDR. There's the high, there's a premium, with 50% of that range, premium section, and then why this is the discount. Midpoint is the 50%. And if you look at this, there's a couple of bearish forming lower lows and lower high, lower lows and lower high. And there is a liquidity, a bunch of liquidity sweeps here. But what to look out for when it breaks this high, we should look out for fair value gap. I think around the second chart, okay, this is under high. Yeah, but this is not a very high probability setup, whereas it's found the bucket above here. If it was a direct sweep and then you see the candle forming, showing that it has bullish intent, then that's a good setup to jump into. Because you can still see some more bullish breaker blocks around here. This is a choppy market. It's not really moving anywhere. Look out for bullish breaker blocks wherever you see a clean price action. In a choppy market, I wouldn't advise you to jump into a choppy market. So with this now, I think we've covered bullish breaker blocks. You wait for the market to take a dip. Whilst the market is taking a dip, once it has a liquidity sweep, look out for the last series of bearish candles that are formed before the liquidity sweep. Then you can have to go long while the market crosses decisively above them, not for the market to retest those bearish fair value gap. Then you can go long off of that. After the decisive close and the fair value gap forms, then you can go long from there. So with this now, I think we must see that now into some other critical factors of managed breaker blocks later on the lecture, not on this lecture, but in other lectures. But this is more like an introductory class, so that's in wouldn't look like a rocket science when you're looking at charts and see when there's a momentum or impulsive move high, and you say you don't know what to do. But if there's a impulsive move high, wait for the market to retest. Patience is key in this market. Patience is key. You don't go chasing price back. If you chase price back and you end up having any problem with your account, that's just the result of chasing price pattern. It's not advisable at all. So with this now, we'll come to the end of this lecture. Hope we can get to top this. We'll get more insights and send to you what I've been trading a bullish breaker blocks for long time. Once I see there is a sweep of liquidity, yes, that's a good set of does. Time to look for longs whenever the market retests. That's it retests the sales of bearish, retests the high of those series of bearish candles that took out that liquidity graph. So with this now, I hope we can dive more into other institutional reference points in the PDRs on a later lecture. Thank you, everybody. Have a good day.